Hi everyone, it's Anthony here. I'm going to be taking you through another past paper. We're going to be looking at FAC1501. This is the May-June 2016 paper. Let's have a look at the questions we haven't covered yet. Question 1 is multiple choice. 25 marks, 30 minutes. Select for each question only one alternative that you consider to be correct and then circle the correct alternative. Right, 1.1. The general ledger account, land and buildings, will be classified as. Land and buildings, you should know, is a non-current asset. 1. AB traders purchase inventory for 15,000 on credit from CD wholesalers. AB traders use the perpetual system. Which account will be debited and which account will be credited? Okay, that's pretty easy to do. Remember, we're using perpetual, so we talk about inventory as inventory. Okay, so if I'm purchasing inventory, it will be an asset. The asset will increase, and it's on credit, so the liability will increase. Okay, so creditors control will be credited, yes. And the inventory account will be debited. That would be the right answer. 3. Creditors is the liability goes up on the credit. Inventory is an asset, goes up on the debit. 3. 1.3. In the financial statements, accrued expenses will be classified as. That will be seen as a current liability. Accrued expenses are expenses that haven't been paid yet, so they're still outstanding. Current liability 4. A tenant of PT paid 7,000 for renting a part of the premise. Which of the funding alternatives is correct? Okay, so they paid, meaning you would have received 7,000 for rent. So rent expense would have gone. Well, a tenant of PT paid for renting part of the business. So we're going to be renting out the building, so it's rent income. The rent income account of PT traders will decrease? No. The bank account. Okay, so a tenant of PT traders paid 7,000 for renting a part of the premises. Okay, so the tenant is paying PT, they're receiving, so bank will go up. The bank account of PT will decrease? No. The rent expense account of PT, it's not a rent expense. The bank account of PT will increase. That's right. Okay, they're not looking at the rent income part here. Okay, obviously, if we're looking at things from PT's point of view, PT would have been the business that has rented out a part of the building to a tenant. So the bank account will go up. 3. IT paid 6,000 to CD, a creditor, in part settlement of their account. Okay, so if you're paying a creditor, the liability will decrease. Liabilities decrease on the debit side. So debit the creditor's control, credit the bank. Okay, we're looking at paid 6,000 to CD. Okay, so creditors is a liability, liability decrease, asset decrease. Option 4. CD traders received 1,000 from PT, a debtor, in part settlement of their account. Okay, so if we're CD traders, we're receiving a payment from a debtor, so we're receiving. If I'm receiving money, bank is going to go up, it's going to be debited, and who did I receive from? A debtor, so the debtors will go down. Debtors decrease, asset decrease, asset increase. Okay, so CD received 1,000 from PT. It'll be plus and minus under assets, option 2. 1.7. KL sold goods on credit to PT. The cost price of the goods was that. KL uses the perpetual system. Okay, the accounts to be debited and credited in the general ledger of KL for the above transaction. Okay, so the perspective is focusing on KL. So KL traders sold goods on credit. If they sell goods on credit, the accounts will be debited and credited in the general ledger of KL. Okay, so KL is recording the transaction. KL sold goods. So if they're selling goods, you'll have debtors and you'll have sales. Okay, debtors would have been debited, sales would have been credited. And it's perpetual, so you'll have a debit for cost of sales and you'll have a credit for inventory. Right, because there's 4 accounts because it's a perpetual system. Right, so debit debtors, credit sales, debit debtors, credit sales. Okay, that would be right. And then debit the cost of sales, credit the inventory. Option 4 is correct. Okay, debit debtors, debit debtors, credit sales, debit cost of sales, credit inventory. Good. Okay, 1.8. In the financial statements, cash float will be classified as its cash float, so it's viewed as cash and cash equivalents. 1.9. ST paid the telephone account 3,000 with a business check. If they're paying with a business check, the business's bank account will decrease. So bank will decrease on the credit. They're paying a telephone account, so there's an expense. Okay, so it'll be either 1 or 3 depending on what we have in the actual counting equation. Right, so bank is credited, bank comes down by 3,000. Telephone is an expense, the expense will affect owner's equity. So that's the right answer, option 3. In the financial statements, credit loss will be classified as an expense. Okay, it's a loss. Okay, if you're losing something, it's an outflow of benefit. It meets the definition of an expense. Okay, and that's the multiple choice. Right, question number 2. 26 marks, 31 minutes. We're looking at what here? Okay, they've given us journals. They say open the bank account in the general ledger and post the applicable accounts in the above subsidiary journals to the bank account in the general ledger. Okay, so we need bank. Open the debtors control account and post from the above journals to the debtors control, and then open the creditors. Alright, so we need T accounts. So question 2 is looking at T accounts, which is general ledger. Okay, from journals. Okay, so we're taking the information from the journals and we're posting it through to the general ledger. Okay, the general ledger accounts. Right, so we don't have to do all the accounts, we're just doing bank. Okay, so let's draw up a bank column here. Then I'm going to have debtors and creditors. Okay, so I'm going to do that there. Debtors control, or debtors control debtors. That's what they gave you in the question. And then creditors control. Alright, so that's what they've asked you to do in this question. A is the bank, B is the debtors, C is the creditors. You do not have to balance or close off the accounts. Okay, so you don't have to total up and balance, brought down, balance, carry down. Okay, I'm going to show you guys the balancing just so you know how to do it, but it wasn't specifically asked for. They said do not, okay, balance or close off the accounts. Alright, so all I need to do is go to each journal and I need to think about what's happening in each column. Okay, so let's go right to the beginning. Okay, let's start with the first bit. PT Stores is a trading entity registered as a VAT vendor. Okay, so is VAT applicable? Yes, it is. They're using the periodic system. Okay, so I'm talking about purchases, not inventory. And control accounts are in use. Right, the bank account in the general ledger had an unfavorable balance of that on the 1st of August. Right, obviously you've got journals for August, so you need to start with the balance. So that's an easy mark to get in your bank account. It's an unfavorable bank balance, so it'll be seen as a credit because it's a negative, it's a liability. Right, unfavorable bank balance, 160,000 on the 1st of August. Okay, so 1st of August, balance brought down 160,000. Okay, that's a transaction that I've recorded now, or a balance that I've recorded. On 1 August, the balances of the debtors control and the creditors control account in the general ledger were 300,000 and 250 respectively. Okay, so balances of the debtors control is 300 and creditors 250. So debtors is an asset. Assets will have debit balances. So balance brought down 300,000. Okay, creditors would have 250. Creditors is a liability, so balance on that side. 250,000. The following transactions by PT took place during August 2015. Okay, so now we're going to be looking at each of these different journals. Right, so now I'm looking at accounts, okay, that affect bank, debtors, and creditors. Okay, so what do I have here? I have the cash receipts journal. Right, what would the bank here do to the cash receipts journal? Or what would the cash receipts journal do, rather, in terms of the bank column? What will it do to the bank general ledger? Well, if I'm receiving money, bank is going to go up. So bank is what type of account? An asset. If the asset is going to go up, it's going to be debited. So 627,500, that amount is going to go on this side of the account because it's going to increase the bank account. Okay. Total receipts, cash receipts journal, and the amount was 627,500. 627,500. There's the bank. Okay, then we've got sales. Did the question ask me for the sales tier count? No, so I don't need it. Did the question ask me for VAT output? No, they didn't. Did the question ask me for debtors? Yes, they did. Okay, if this is the cash receipts journal, why do you have 300,000 in the debtors? Alright, column for the cash receipts. Well, what's the relationship with your debtor? Well, debtors buy from the business, so the business would have sold to the debtor. Okay, if the business is selling to the debtor, at some point in time the business is going to collect the outstanding amount. So if they're collecting, the debtors is going to decrease. So 300,000 is going to come off the debtor's control because it would have been received. Okay, so 31 August, bank, cash receipts journal, and the amount 300,000. Okay, debtors control as an asset, it's decreasing because customers are paying us as a business. The business is receiving. So do you have more or less debtors? You'll have less debtors. Less debtors mean the debtors will decrease. Debtors will decrease on the credit side, and there's the 300,000. Okay, capital, did they ask me for? No. Rent, did they ask me for? No. Alright, now we need to look at cash payments. Did they ask me for the bank tier account? Yes, they did. So what are payments going to do to your bank account? It'll decrease your bank account. So if your bank account is going to decrease, you're going to record that on the credit side. So 31st August, total payments, cash payments journal, amount 513,603, 513,603, 513,603, 513,603, that's fine. Okay, did they ask you for the creditors? Yes, they did. So what's the relationship with the creditor? Well, as a business, you would be buying from them. So if you're buying from a creditor, you're going to owe them. At some point in time, you're going to make a payment. This is the cash payments journal. So why do I have creditors in the cash payments journal? It's because I've paid some of the liability off. So creditors of 140,000 have been paid. Creditors is liability. The liability will decrease on the debit side. So 31st August, bank, cash payments journal, 140. Right, wages, did they ask me for that tier count? No. VAT, did they ask me for that tier count? No. Furniture, did they ask me for that tier count? No. Salaries, did they ask me for that tier count? No. Okay, next question, or next journal. Right, the purchases journal had the following totals. VAT. Did the question ask me for VAT? No, they didn't. So I don't need to specifically record VAT. Did the question ask me about purchases? No, they didn't. Okay, did the question ask me for creditors? Yes, they did. Okay, so if I'm looking at a purchases journal, when making a purchase from a creditor, your liability will increase. Okay, so you're obviously going to debit the purchases, and you're going to debit the input VAT. And you're going to credit the liability, which is the creditors. Okay, so when I buy something from a business on credit, the liability here will increase. Liabilities increase on the credit. Okay, so this amount is the VAT inclusive amount. This is the VAT exclusive, and that's the VAT. Right, so do you agree in terms of the amount outstanding, the creditors are owing 441,750, and that, okay, comprises of the purchases and the input VAT. Okay, so those are two separate accounts that make up the total 441750, right? Because we're debiting the purchases, we're debiting the input, and we're crediting the creditors, right? So this amount, the total, needs to be shown under creditors, but the total needs to be broken up into purchases and input VAT. Okay, so what's going to happen to my creditors? Well, did I buy or sell? I bought. So on the 31st of August, okay, your creditors is going to go up, the liabilities go up on the credit. It's going to go up by how much? Well, 441750. A portion of it is purchases and a portion of it is VAT. So purchases, okay, purchases journal, right? And then the same thing here. Paste that. Copy paste. All right, and this will be input VAT. Okay, so I'm showing it separately because both amounts make up the total. Okay, you know you pay the VAT exclusive plus the VAT, which is the VAT inclusive, when you make a purchase. Right, so 387,500, 387,500, and 54250, 54250. Right, that's the creditors. Okay, the total is obviously the 441750. Right, 441750. Right, next transaction, purchases returns journal. Right, so now this is the complete opposite. Okay, you're returning something you've purchased. So is your liability going to go up or down? Well, here the liability is going to go down. The liability is going to go down because you return some of the goods, okay, and some of the VAT will be reversed out. Right, so those amounts are important because the creditors control is going to decrease, and creditors is liability, so liabilities decrease on the debit side. Okay, so I'm going to write down purchases returns from the purchases returns journal, and input VAT is going to be reversed out, purchases returns journal. Okay, the amount here was 64 and 8960, 8960. Right, and that's the creditors control. Okay, next bit, sales journal. Alright, so now we need to think about what happens here. Well, if I'm selling goods, I'm going to sell goods on credit to my debtors. Debtors is going to go up, so debtors will be recorded on the well, in debtors you'll be debiting the debtors. Okay, and you're debiting the debtors because of the sales and the output VAT. Okay, that's why you've got an amount. Okay, because think about this, if you're selling something to someone, okay, you're going to be selling that item to them at the VAT inclusive amount. Okay, your customer is going to owe you the full amount, okay, which was the VAT exclusive. So that's the VAT exclusive, that's the VAT, and if you add those two amounts together, you're going to get the total amount that they owe you. Right, so debtors are going to owe that amount. The debtors have to pay the 64195, and it comprises of two things, sales and output VAT. So if debtors are going to owe us and they're going to be increasing, you're going to have debtors on this side of the account. Okay, so sales from the sales journal and output VAT because you're selling, and the sales is how much? The sales 231,750, 231,750. The VAT 32,445, 32,445. Okay, 231,750, 231,750, 32,445. Here we go. All right, next, sales returns journal. Okay, so maybe just to write this down, just to show you something, you would have debited the debtors. Okay, you would have credited the sales, and you would have credited the output VAT. Okay, that's your workings that you guys are familiar with, that you always do when analyzing transactions. Okay, so when I have a sales return, the opposite occurs. Right, now you are going to be receiving goods back from your Customers. Okay, your customers have bought and now they've returned. Okay, so debtors are going to go up or down. Debtors are going to go down. Right, debtors go down on which side? Well, debtors is an asset. Assets decrease on the credit side. Okay, so I'm going to write down sales returns from the sales returns journal, and output value is going to be reversed out from the sales returns journal. Amounts here, okay, well, those amounts are going to be added to get that total 63,840. 56,000 is the VAT exclusive, and 7,840 is the VAT output. Right, and those are all the journals. Right, they said don't balance or close off the account, so we don't have to go any further. Right, that's the end of this question. Okay, I would balance the account just to show you how to do it. Okay, so when balancing the accounts, you're just looking at which side is bigger. Okay, so in this scenario, that is bigger or smaller. 67, yeah, 67 is bigger. Okay, so I'm going to sum up those two amounts. I get that answer. Okay, so your credit side is bigger. Then on the 31st of August, okay, you'll have a balance carried down. And then on the 1st of August, September, you'll have a balance brought down. Okay, and the balance brought down is going to be the difference between what you have here and what you have over there. Okay, that's the difference. Right, so 1st September, balance brought down would be that amount. Okay, so the bank still has an unfavorable bank balance. It's a credit balance for bank. So bank actually isn't an asset, it's actually a liability, okay, which is a bank overdraft. Right, you do the same thing here. You would sum up debit and credit. Okay, you would expect the debit side to be bigger because this is debtors. Right, and I would then balance this account off. Okay. Alright, so to balance this account, I'm going to take that total minus those amounts there to get the balance that I'm going to carry down. Right, same thing with creditors. You would expect this side to be bigger, so if I sum up those three figures, I'm going to get that equals that amount equals this minus that minus that minus that gives me the difference. Okay, so that's balancing. Alright, the question said you don't need to do that. Okay, but I've done it just to show you how to do balancing, just something additional. Right, you didn't have to do the balancing, they just wanted these line items that you had to post through to your debtors. Okay, and that's question number 2. Right, question 3 we've done in a separate video, so please have a look at that for the bank reconciliation. This was a nice bank recon question. It was worth 21 marks and it was for 25 minutes. Alright, I need to do disclosure. Disclosure question, where are you? There's it, question 4. Alright, so 28 marks, 34 minutes, that's the amount of time you have for this question. We've got a list of accounts. Okay, so what I would suggest you guys do before I do this question is maybe pause the video here, see if you'd be able to correctly identify what each and every one of those accounts are. Right, so capital, drawings, land, equipment, etc., etc. Go down the list and test yourself and see if you'd be able to identify what they are. Once you know what they are, alright, and once you've answered those questions, then come back and start the video again. And then look at how do I actually post this through. Okay, so what am I trying to do here? Well, I'm doing a profit or loss and other comprehensive income, and I'm looking at a statement of changes in equity. Okay, so this is disclosure. Alright, so obviously if I'm looking at disclosure, the statement of comprehensive income, okay, or profit and loss and other comprehensive income, if you want to write down the whole word, profit and loss and other comprehensive income. Okay, obviously for the year ended what year? 30th June 2015. Right, and then you need a statement of changes in equity. Okay, so that's the one statement. Right, and then you'll have another statement, which is the statement of changes in equity. Okay, and the statement of changes in equity will have one column, okay, for capital, right, because you're looking at a sole proprietor. Okay, and then you'll have an opening balance, so balance bracket, the year end was 30 June 2015, so this will have been 1st of July 2014. Okay, and then the balance bracket 30 June 2015, close brackets. Alright, so that's the format. Okay, obviously format is something that you need to learn and study. Okay, so have a look at the study guide examples, or even look at the textbook. Well, yeah, the study guide is the textbook, so have a look at that and see what the actual format is. Okay, then obviously in the statement of changes in equity, you'll have profit for the year. Okay, the owner is obviously entitled to the profit. The profit we get from here, the statement of profit and loss and other comprehensive income. Okay, in the statement of profit and loss and other comprehensive income, you always start with sales and you less the cost of sales. Okay, so sales less cost of sales is going to give us a total for gross profit. Okay, then I'm going to have other income, and then I'm going to have other expenses. Okay, obviously other income and other expenses are totals. Okay, I'll list all my income and all my expenses underneath. Okay, so let's have a look at, did they give you disclosure? Okay, yeah, they did. They gave you the layout here, right? They've given you 2 columns. All right, so I'm also going to use 2 columns then, just to show you how you would actually record that. Okay, so those are my 2 columns. All right, obviously rands. Okay. Alright, so I'm hoping that you guys had or have gone through all of those accounts and you know what they are. Okay, capital we know is what type of account. Well, remember this is a pre-adjustment trial balance. So if it's pre-adjustment, it's before you've processed any of those additional information points, okay, which we're going to look at just now later on. Okay, so if I'm looking at pre-adjustment trial balance, it's before I've adjusted, so the capital hasn't been adjusted, so 2.5 million would have been the balance that I would be starting with. Okay, so 2.5 million there would be the balance that I'm starting with. Right, drawings. Okay, drawings will affect who? The owner. So if it's affecting the owner, it'll affect the owner's equity. Right, so obviously you'll less drawings. Okay, and the drawings was how much? 174,300. 174,300. Right, equipment and buildings at cost. You should know equipment and buildings is an asset. Assets go to the statement of financial position. I'm not looking at that statement, so I don't need it. Equipment also goes to the asset, which is also statement of financial position. Depreciation is a negative asset, goes to statement of financial position. Inventory is an asset, so it'll go to the statement of financial position. Debtors control is an asset, it'll go to the statement of financial position. Bank is an asset, it'll go to the statement of financial position. Creditors is a liability, it'll go to the statement of financial position. Assets, well, petty cash is an asset, it'll go to the statement of financial position. Right, there's a line item I need, sales. Okay, so 7,002,240. Right, so what is my sales figure? My sales figure is 7,002,240. Right, 7,002,240. 7,002,240. Great. Cost of sales, they gave that to you. If you see cost of sales, you know they're using a perpetual system. Right, so if it's perpetual, 5.6 million is going to be taken off your sales. Right, so sales minus cost of sales gives me gross profit. Okay, gross profit is obviously sales less cost of sales. Right, that's the understanding, that's the knowledge that you should have, okay, when approaching the question. It's just income. Income minus expense gives me a profit. Okay, that's the income, that's the expense, this is the very specific profit, because I'm only looking at those 2 income. Okay. Right, what else do I have? Sales returns. Okay, sales returns would be seen as an other expense, or you could disclose it against your sales. Alright, so it depends how you want to disclose it. Okay, because this is a sales return, it would be better to show this against your sales. So open brackets 7002240, okay, minus the, what is the sales returns? 18210. 18210 asterisk sales return. Okay, so that would be better in terms of disclosure. Okay, presentation. So I should actually update this figure. Okay, so if I take the 7002240 and I subtract the 18210, I'm going to get that answer. Okay, then I just need to update my gross profit. Right, because here they did give you sales returns. Okay, so it would be better to show it here in brackets as a working. Okay, instead of another other expense. Right, consumable stores purchased during the year. Consumable stores would be seen as an expense, 11,500. Okay, I'm writing it in that column because I'll put a total here for the cash. Well, not cash, other expenses. Right, insurance is an expense, 25,000. Telephone expenses is an expense, 10,000. What's the next one? Water and electricity is an expense, 32,800. Next one is settlement discount granted. Okay, discount granted would have been seen as a expense. Okay, again, with the settlement discount granted, because it relates to your debtors, right, you could also show that as part of this working against sales. Right, I prefer to show things separately. Okay, the sales returns, I would disclose it against the sales. The settlement discount granted, you could show it against the sales as well, so you would subtract it from there. Okay, or if you want to, I would show it separately like I'm doing here. Okay, so settlement discount granted, the net effect in terms of total will still be the same. Right, 1240, 1240. Right, settlement discount received, it's a receipt, okay, 1,000. So that'll be other income. Ah, 1,000. Okay, rent expense is an expense, 48. Stationery is an expense, 20. And 32 for wages, also an expense. Okay, now we need to look at these adjustments. Okay, so those are the easy marks in the question. The adjustments is slightly more tricky and more difficult to do because you need to think about your adjustments. Okay, if you refer to your notes, you'll see in the last few notes or slides rather, in your notes you would have seen we spoke about different adjustments like accrued expenses, prepaid expenses, accrued income, income received in advance, those types of things. Okay, so I do recommend you guys have a look at that, just so you can understand what the actual theory is. Once you've learnt the theory, then we just need to practice applying it. Right, so this question is applying the adjustments. Okay, so number one says HR uses the perpetual inventory system. Okay, we already knew that because I saw cost of sales. When I see cost of sales, I know this is perpetual. If I saw purchases, then I would know this was periodic. Okay, so number one is just great. Thank you for telling us that. Right, number two, inventories on hand at 30 June according to the actual physical count was. Okay, so now here you're counting stock. Right, merchandise is inventory. That would have been your closing stock. Closing stock would have been disclosed in the statement of financial position. Right, that's not going to affect the statement of profit and loss and other comprehensive income. Right, consumable stores. Well, if you look at the notes, okay, that we covered in terms of theory, you would see there that we spoke about inventory expense adjustments, okay, where you have expenses that you haven't fully utilized. Right, so here we know consumable stores is things that we've purchased during the year, which is seen as an expense. But because I haven't used all of it, for one day of the year, it's seen as an asset because it hasn't been used. Okay, so this consumable stores up here, that amount there, okay, let's delete some of this other writing. Okay, alright, so this consumable stores over there, okay, that amount is actually too high because you haven't used all of it. Okay, so if you haven't used all of it, you can't show all of it as an expense. Okay, so consumable stores of 10,000 is left on hand. So the expense for the year is actually less than the 11,500. So consumable stores needs to be adjusted. 11,500 less 10,000. Okay, it's an adjustment, minus 10,000 gives us 1,500. Right, number 3 says prepaid insurance amounts to 2,000. Okay, so again, refer to the notes to recap what a prepaid insurance or prepaid expense account is. Okay, I'm going to revise it, the concept. Okay, so if I've prepaid insurance, I've prepaid for an expense that's going to occur later on. Okay, I've prepaid something. If I prepay something, it's viewed as a asset. Okay, so what are we focusing on? We're focusing on the expense. Is the expense too high or too low because I've prepaid it? Well, in the year that we're looking at, we've paid more insurance than we're supposed to. So the insurance is too high. Okay, you're recognizing insurance for other periods that are only going to occur in the future. Okay, you've prepaid insurance. If I've prepaid the insurance for the next 2 years, okay, I can't show 2 years worth of an expense now, okay, in the current financial year. In the current financial year, I can only show 12 months worth of an expense. So because this is prepaid, it means your insurance is too high. You need to reduce it by 2,000. Okay, so insurance is going to have a working here. 25,000 minus 2,000 gives you 23,000. We need to change that to a 3. Okay, and then they said here, provide for depreciation as follows. Right, 10% using the reducing balance method. Okay, reducing balance method is another word for diminishing balance method. Right, is depreciation an expense? Yes, it is. So depreciation will be disclosed here. Right, we need to show a working because we have to provide for it. Okay, so 10% on the diminishing balance, and we're looking at the equipment. Okay, so now I need to go back to the question, and I need to look at the equipment cost and the accumulated depreciation. Right, because if I'm looking at the reducing balance method, the reducing balance method is going to utilize the carrying value. Okay, so I'm focusing on carrying value here. Okay, that's what I'm going to be looking at. Okay, so if I'm looking at carrying value, I'm going to have to record the amount, okay, which is the cost, which is 213. Okay, so 213 costs minus accumulated depreciation, 213000. What is the accumulated? Accumulated depreciation was 143,250 minus 143,250. Okay, then times that by 10% because it's diminishing balance. Right, so with diminishing balance, you always work out depreciation on the carrying value. Right, the carrying value is your cost minus your accumulated depreciation. Right, again, if you can't remember that, please refer back to the notes. We covered property, plant, and equipment in one of the chapters, and we spoke about depreciation according to the diminishing balance method, and that requires the carrying value, which is the cost minus the accumulated depreciation times the 10%. Okay, and that's the end of this question. All you need to do now is total up. Alright, so if I'm totaling up, I'm obviously going to add and subtract, and I'm going to land up with a profit for the year figure. Right, so expenses, I need to sum up all of these figures there, and that gives me all my expenses. Right, just remember UNISA is going to want you to show this as a negative. Okay, so in accounting you show negatives in brackets. Okay, so I'm just going to put it in red, okay, because I can't really put a bracket in Excel. All right, I can show a minus in front, but you need to show it in brackets. Okay, so you'll have cost of sales, you'll have that amount in brackets. You'll have this amount in brackets because brackets mean negative. Okay, then other income. There's the other income. I've only got one figure, so I'll leave that as the discount that you received. Okay, those are good figures. Alright, so how do I get profit for the year? Well, it's the gross profit plus other income minus other expenses. Okay, so this plus that minus this gives me that answer. Okay, who gets the profit? The owner. Okay, so this is going to be referenced in the statement of changes in equity. Profit for the year is going to be to 1209515. That's the profit for the year. All right, and then we just need to balance this account off. Okay, so obviously drawings is bad, it's negative, so you would subtract it. Okay, so the balance at the end of the year would have been the balance here plus the profit that you make minus the drawings that you take, and that's what the owners have left over, okay, in terms of their capital. Right, and that's the disclosure question, and that was question number 4.